You know what's one of the strangest things I see almost every day? People throwing money into the stock market like they're buying lottery tickets, convinced that the next hot stock or crypto coin will change their lives. Meanwhile, they're sitting on thousands of dollars in credit card debt that's quietly draining their future. It's like watching someone try to fill a bucket that's leaking from the bottom. They keep pouring more water in, completely ignoring the holes. And here's the thing, most of them aren't stupid. They're just following the noise. Financial influencers screaming, buy this dip, invest early, compound interest is magic. But here's what nobody tells them. Order matters. Investing is not about how fast you throw your money into the market. It's about where you put it first. If you invest in the wrong order, you can destroy years of progress before you even realize it. I'm Mike Compound, and I spend a ridiculous amount of time thinking about money. Not because I'm obsessed with getting rich, but because I'm obsessed with getting it right. If you've ever wondered what's the smartest way to invest your money, step by step, without wasting years chasing trends or getting crushed by debt, then you're in the right place. Before we dive in, let me tell you a story I see far too often. Someone starts making decent money and decides it's time to become an investor. They download an app, open a brokerage account, and buy a few flashy stocks. They feel proud, like they've finally joined the smart money club. But a few months later, an emergency hits. Their car breaks down, or they get hit with a medical bill. And guess what? They don't have savings. So they pull money out of those shiny new investments right when the market's down. They sell at a loss, take on more debt, and end up right back where they started. That's not an investing strategy. That's financial roulette. The truth is, most people are doing everything backwards. They skip the boring but essential steps, the things that actually protect their future, because those steps don't sound exciting. Nobody brags about building an emergency fund or paying off high-interest debt. They brag about buying Tesla stock at $120 or getting in early on some random crypto token. But the people who truly build wealth, they play a different game entirely. Here's something shocking. 1 in 3 Americans doesn't have an emergency fund at all. And the median amount saved for emergencies? Around $500. That's less than the average car payment. Think about that. Millions of people are one flat tire away from financial panic, yet they're out here asking which stock to buy next. It's like asking whether you should buy a Ferrari when you can't even afford to replace the engine in your current car. There's an optimal sequence for investing your money, a proven order that minimizes your risk, multiplies your returns, and builds true financial freedom step by step. But because it's not flashy, people ignore it. They chase the excitement instead of building the structure that supports long-term success. Imagine trying to build a house starting with the roof. You wouldn't do that, right? You'd start with the foundation. Yet most people's financial houses are built upside down. They're decorating the living room while the ground beneath them is cracked. Let's fix that. In this video, I'll walk you through the smartest order to invest your money. Exactly how to go from struggling to save, to building a solid base, to finally investing with confidence. You'll learn why your employer match is basically free money, why paying off certain debts gives you a guaranteed return that beats the stock market, and why one of the most underrated accounts in America might secretly be the best investment tool ever invented. But before we start stacking those steps, let's get one thing clear. Getting the order wrong isn't just inefficient, it's expensive. Every month you delay paying off high-interest debt, you're losing money faster than most investments can earn it. Every month you ignore your employer's match, you're turning down free cash. Every month you put money into a taxable account before maxing out your tax-advantaged ones. You're donating unnecessary dollars to the IRS. The sequence matters. The foundation matters. That's why we're going to rebuild your financial plan from the ground up. We'll start by plugging those leaks. Because if you're trying to fill a bucket full of holes, you'll never make progress, no matter how much you pour in. Once the leaks are sealed, that's when compounding finally works in your favor, not against you. So grab a pen, because in the next part, I'll show you the very first step, the one most people skip, but every financially successful person prioritizes. It's not glamorous, but it's the difference between living in constant financial chaos and finally having control over your money. Before you invest a single dollar, before you even think about stocks, ETFs, or crypto, there's one rule that separates financially secure people from everyone else. Build your foundation first, and that foundation begins with an emergency fund. Now, I know that doesn't sound exciting. Nobody opens TikTok to watch videos about emergency funds. But let me tell you something. This single, boring step can save you from years of financial setbacks. It's not just about having money for unexpected expenses. It's about building a psychological shield between you and panic. Because here's the truth. Life is unpredictable. Your car breaks down. Your job cuts hours. A medical bill lands in your inbox that looks like a phone number. If you don't have an emergency fund, you'll turn to debt, usually credit cards. And the moment you do, you're playing a game you can't win. So let's talk numbers. According to the latest data, 1 in 3 Americans doesn't have any emergency savings at all. 0. And for those who do, the median amount is only $500. That's barely enough to fix a water heater, let alone handle a medical emergency or a few months of rent. But here's where it gets interesting. Vanguard did a study and found that people with just $2,000 in emergency savings had financial well-being scores that were 21% higher than those with none. Not because $2,000 makes you rich, but because it makes you resilient. It's peace of mind. Let's break it down step by step. Step 1. Save your first $1,000 as fast as you can. Don't overthink it. Sell something. Pick up an extra shift. Cut out a few luxuries. Whatever it takes. That first $1,000 isn't about financial freedom. It's about stability. It covers the small surprises that would otherwise send you back into debt. Step 2. Once you hit that $1,000, work toward 1 month of living expenses. For most people, that means rent, food, transportation, and utilities. Having 1 month saved means you can handle small job disruptions or unexpected repairs without pulling out the credit card. Step 3. Build that fund to cover 3 months of living expenses. This is your financial safety net. If you're self-employed, a freelancer, or in a volatile industry, stretch it to 6 months. Think of it as your personal insurance policy, not just against emergencies, but against bad timing. Because when markets drop, and they always do, you don't want to be the person forced to sell investments at the bottom just to pay bills. Your emergency fund gives your investments time to breathe, recover, and grow. And here's something nobody talks about. An emergency fund doesn't just protect your wallet, it protects your mindset. Once you have savings, you make decisions from a position of strength, not fear. You negotiate better. You think clearer. You don't stay in toxic jobs or panic during market dips. Most people skip this step because it feels slow. They want to invest right away, to see numbers go up, to start compounding. But skipping the foundation is like trying to build a skyscraper on sand. It might look fine for a while, but the first storm will bring it down. Let's be honest, saving isn't fun. It's discipline without immediate reward. But this is where the mindset shift happens. When you stop chasing excitement and start building structure, every dollar in your emergency fund buys you freedom. Freedom from fear, freedom from bad timing, freedom from debt traps. Now you might be wondering, where should I keep my emergency fund? The answer is simple. Somewhere safe, accessible, and boring. A high-yield savings account works perfectly. Not the stock market, not crypto, not your checking account where it might accidentally get spent. This money is not for investing. It's for protecting your investments. Think of it as your first financial milestone, the line that separates chaos from control. Once that foundation is in place, everything else starts to make sense. So by now, you've got your safety net. You've built the wall that stands between you and financial disaster. The next step? It's time to hunt down the biggest wealth destroyer that exists, the silent killer that eats more money than taxes, inflation, or bad investments combined, high-interest debt. In the next part, we'll go deep into how debt keeps people broke, not just mathematically, but psychologically, and how to eliminate it in the smartest, fastest way possible while still building momentum. Now that you've built your emergency fund, it's time to face the villain that quietly steals your future, high-interest debt. Debt isn't just a financial problem, it's an emotional one. It keeps you up at night, makes you hesitate before spending, and robs you of that sense of progress that money is supposed to bring. The worst part? It convinces you that investing will fix it, that if you just make more in the market, everything will balance out. But mathematically, that's a losing battle. Here's the truth. No investment can reliably beat 22% interest. And yet millions of people are trying. They're buying index funds, crypto, and options trades while paying 20+% on credit card balances. That's like running a marathon with a refrigerator on your back and wondering why you're not winning. Let's look at the numbers. The average credit card interest rate today sits above 22%. If you have $5,000 in credit card debt and make only minimum payments, you'll hand over nearly $2,800 in interest over 5 years. And that's if you never swipe that card again. That's money that could have been compounding for you instead of against you. Every dollar you use to pay off that debt is essentially earning you a guaranteed 22% return, better than anything the market can promise. So if paying off debt gives you a guaranteed return higher than Warren Buffett's lifetime average, why do so many people ignore it? Because paying off debt feels like going backward. You don't see numbers go up. There's no dopamine hit, no green arrow on a chart. But real wealth isn't about excitement. It's about control. The fastest way to take back that control is with a strategy. There are 2 main ones, the debt avalanche and the debt snowball. The debt avalanche method focuses on math. You list every debt by interest rate, pay the minimum on all of them, and then throw every extra dollar at the one with the highest rate. Once that's gone, move to the next highest. It's the most efficient path because it minimizes the total interest you pay. The debt snowball method, on the other hand, focuses on psychology. You pay off the smallest balance first to get a quick win, then roll that freed-up payment into the next debt. It's less efficient mathematically, but the momentum feels powerful. You see progress faster, and progress keeps you motivated. There's no wrong choice here. What matters is that you stay consistent. Pick the system you'll actually follow and stick with it. The key is to attack debt intentionally, not emotionally. But there's one exception to the pay off debt first rule, and it's a big one: your employer match. If your company offers to match contributions to your retirement plan, contribute enough to get the full match even while you're paying down high-interest debt. Why? Because that match is free money. A 100% return on your contribution the moment it's deposited. Here's an example. Your employer matches 50 cents on the dollar up to 6% of your salary. If you make $50,000 and contribute $3,000, your employer adds $1,500 instantly. That's a 50% gain before your investments even grow. No credit card payoff or stock trade can replicate that. Once you've captured the match, redirect every extra cent back to your debt until it's gone. That way, you're not missing out on the one guaranteed boost most people overlook. There's one small detail you need to check first. Some companies have vesting schedules, meaning you might need to stay with them a certain number of years before the matching funds fully belong to you. Even so, for most people, the immediate benefit outweighs the risk. Think of these 3 steps: emergency fund, debt elimination, and employer match as the concrete foundation of your financial house. Without them, every investment you make stands on shaky ground. But once they're in place, you've built something unshakable. From here, you can finally start focusing on growth, the part where your money begins working harder than you do. In the next section, we'll move into the part of the plan that most people misunderstand completely: how to use tax-advantaged accounts in the right order. This is where you can save tens of thousands of dollars over your lifetime, not by taking more risk, but by being smarter than 95% of investors out there. By this point, your finances are stable. You've built your emergency fund, killed your high-interest debt, and captured your employer's free money. Now it's time to climb what I call the tax-advantaged ladder, the order of investing that allows your money to grow faster simply by paying less in taxes. Most people get this part completely wrong. They rush to open brokerage accounts because it feels flexible and exciting, while ignoring the retirement accounts that could be saving them thousands. The result? They lose money to taxes year after year without even realizing it. Here's the truth. When it comes to building wealth, tax efficiency is everything. Every dollar you keep from the IRS is a dollar that can compound for decades. And the earlier you understand this, the richer your future self becomes. So what comes next after your emergency fund, debt payoff, and employer match? It's time to maximize your IRA. Now, why the IRA before your 401k beyond the match? Simple. Control and cost. Most employer 401k plans have limited choices and high fees. You're often stuck with a handful of mutual funds charging 1% or more in management costs. It doesn't sound like much, but over 30 years, that 1% can eat tens of thousands of dollars from your returns. With an IRA, you call the shots. You can pick low-cost index funds or ETFs that charge fractions of a percent in fees. That small difference compounds massively over time, and it can be the difference between retiring comfortably or working extra years just to catch up. For 2025, the IRA contribution limit is $7,000 or $8,000 if you're 50 or older. If you can, max it out every year. It's one of the smartest financial moves you can make. But here's where it gets tricky. Should you choose a traditional IRA or a Roth IRA? It all depends on when you want to pay your taxes, now or later. A traditional IRA lets you contribute pre-tax money, meaning you get a tax deduction today, but you'll pay taxes when you withdraw in retirement. A Roth IRA is the opposite. You pay taxes now, but everything you withdraw later is completely tax-free. So which one's better? Here's the general rule. If you're currently in a high tax bracket and expect to earn less in retirement, go traditional. Take the deduction now. If you're in a low tax bracket and expect to earn more in the future, go Roth. Pay the small tax today and let your future self enjoy tax-free growth. For most young investors, the Roth wins because taxes are likely to rise in the future and their current income is relatively low. For high earners at their peak, the traditional makes more sense. And if you're not sure, split your contributions between the two. That's called tax diversification, and it gives you flexibility when you retire. Now, let's talk about one of the most powerful but overlooked tools in the entire financial system, the Health Savings Account, HSA. If you have a high deductible health plan, you qualify for an HSA. And trust me, it's like a cheat code for taxes. Why? Because it gives you 3 tax benefits, not just one. First, you get a tax deduction for your contributions, just like a traditional IRA. Second, your money grows tax-free while it's invested. And third, when you withdraw it for qualified medical expenses, it's completely tax-free again. No other account offers that triple benefit. That's why HSAs are often called the ultimate retirement account in disguise. For 2025, you can contribute up to $4,300 for individual coverage or $8,550 for families. And here's a smart strategy. If you can afford to, pay for your medical expenses out of pocket and leave your HSA invested. Keep every receipt because there's no time limit on reimbursements. You could pay for a doctor visit today and withdraw that same amount tax-free 20 years from now. By the time you reach 65, your HSA becomes even more flexible. You can withdraw money for anything, not just medical costs, though non-medical withdrawals are taxed like a traditional IRA. But here's the thing. Healthcare in retirement is expensive. The average couple will spend over $300,000 on it. So having a 6-figure, tax-free HSA is like having a secret weapon. If you max out your HSA for 30 years and earn a 7% return, you could end up with over $400,000, all tax-free for medical expenses. That's financial power most people never use. Once your IRA and HSA are maxed, it's time to circle back to your 401k and contribute beyond the employer match. The 2025 limit is $23,500, $31,000 if you're 50 or older. At this stage, your wealth is compounding in multiple layers of tax protection. You're doing what less than 5% of people ever manage to do, using every tool available to keep your money growing efficiently. And that's the beauty of this order. It's not about chasing returns, it's about keeping them. But we're not done yet. Once all the tax advantage doors are fully opened, it's time to explore the final stage, the one most people jump to too early. Taxable investment accounts. That's where freedom and flexibility meet strategy. Now we've arrived at the final stage, the one most people start with, taxable investment accounts. This is where you can invest without restrictions, without contribution limits, and without waiting until retirement to touch your money. But it's also the place where people make the biggest mistakes. Let's be honest, the freedom feels exciting. You can buy individual stocks, experiment with ETFs, trade options, invest in real estate funds, or even speculate on cryptocurrency. It feels like the Wild West of investing. But that's exactly why it's dangerous. The lack of structure makes people overconfident. They think freedom equals intelligence, but in investing, freedom without order leads to chaos. See, every move inside a taxable account comes with a cost, tax drag. Every dividend is taxed, every sale with a gain is taxed, and the more you trade, the more you pay. It's like running a race while someone keeps tossing sand in your shoes. You can still reach the finish line, but you'll waste a lot more energy getting there. Let's put numbers to it. Suppose you invest $10,000 every year for 30 years at an average return of 7%. Inside a tax-advantaged account, you'd end up with about $944,000. But if you did the exact same thing in a taxable account, after paying taxes on dividends and capital gains along the way, you might only end up with around $700,000. That's almost a quarter of your gains gone, just because of taxes. That's why taxable accounts should always come last. Not because they're bad, but because you should use them strategically. Once you've maxed your employer match, IRA, HSA, and 401k, then you can move into this space with confidence. Now here's where taxable accounts truly shine. Flexibility. Need money for a house down payment in 5 years? No problem. Want to retire early before you can access your retirement accounts? A taxable account gives you that bridge income. Planning to pass wealth to your kids? Taxable accounts get something called a step-up in basis when you die, which can erase capital gains entirely for your heirs. That's a massive advantage when it comes to generational wealth. And here's the thing. You don't have to make it complicated. If you want a simple, hands-off strategy that quietly builds wealth over time, focus on low-cost index funds. For most people, 3 basic funds are enough. One that tracks U.S. stocks, one for international markets, and one for bonds. That's it. No daily trading, no guessing the next hot sector, no chasing trends, just steady, consistent compounding. But let me give you a warning. At this point, you'll start to feel the urge to overcomplicate things. You'll hear stories of someone making 300% on a random stock, or you'll see headlines about crypto millionaires. That's when the temptation hits. Maybe I should try that. Don't. Those stories are the exception, not the rule. The people who get rich slowly, methodically, and predictably are the ones who win in the long run. Because the truth is, wealth isn't built from excitement, it's built from consistency. The investors who quietly keep adding to their accounts through every market condition, who stick to the order, who focus on discipline over drama, they're the ones who retire early, debt-free, and stress-free. Let's recap the smartest order to invest your money, the Mike compound sequence. Build your emergency fund. Protect yourself before anything else. Eliminate high-interest debt. It's the silent killer of wealth. Capture your employer match. Never leave free money on the table. Max out your IRA. Take control with low fees and flexibility. Contribute to a health savings account, HSA, the tax triple threat. Max out your 401k. Compound your wealth with tax-deferred growth. Finally, invest through taxable accounts, your flexible, long-term wealth builder. Follow this sequence, and you'll be doing what 95% of people never do. Building a financial life on purpose, not by accident. Because the truth is, investing isn't about being lucky. It's about being organized. The market rewards discipline, not emotion. And once you have this order down, every dollar you earn will have a job, every investment will have a reason, and your money will finally start working harder than you do. So start small, stay consistent, and never skip the foundation. You don't need to be a financial genius. You just need a plan. And if this video helped you see your money in a new light, don't forget to subscribe to Mike Compound. Because here, we make finance simple, one smart step at a time.